Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. First question, Daniel, he says, I've been in Vanguard funds for my entire life because they're low fee. So it sounds like I'm doing the right thing by investing with someone who's charging a lower fee, right? All right, Daniel, now that's a great question, and it's fantastic that you've been with Vanguard for so long. Vanguard's reputation for low fees is well deserved, and that can make a significant difference in your investment returns over time. But let's dive deeper into your situation, especially as you approach or are already in retirement. Investing for income in retirement with reduced risk and volatility becomes paramount. Vanguard offers excellent mutual funds, but as you near retirement, there are a few considerations to keep in mind. First, bond funds versus individual bonds. Bond funds, including those from Vanguard, don't offer the same guarantees as individual bonds do. With individual bonds, you have a fixed interest payment and a known maturity date, which can provide more certainty, crucial for retirees relying on consistent income. Additionally, as you transition from accumulation to the distribution phase, your focus should shift from total return to income generation. Many mutual funds, not just Vanguard's, are designed more for total return, which includes growth appreciation and dividends rather than high income. Now, for retirees, prioritizing income means looking at investments that can reliably generate cash flow without relying solely on market performance. Now, regarding your portfolio size, if you have accumulated more than $250,000, you might want to consider diversifying beyond mutual funds. Individual bonds, dividend-paying stocks, possibly even an annuity could be part of a strategy to enhance income while managing risk and volatility. Now, this approach allows you to tailor your investments more closely to your income needs and your risk tolerance. Now, in conclusion, while Vanguard remains a top choice for many investors, especially during the accumulation phase, as you approach or enter retirement, it may be beneficial to reassess your investment strategy. Consider incorporating more kind of focused investments that offer greater stability and predictability in cash flow. Now, this shift can help ensure that your portfolio supports your financial needs throughout your retirement years. Now, that's a great question. And if you have a question that you would like to send in, you can do so. You can email it to us. Email it to poolelock@poolelock.com. Let's move on. Let's go to our second question today from Peter. He says, when I was looking for advisors, I found that they charge anywhere from 0.5% to 1.5%. How do I know if someone is worth that higher fee? Absolutely, Peter. You're on the right track by exploring fee-based advisors, especially those held to a fiduciary standard. This ensures they prioritize your best interests without conflicts of interest that can arise with commission-based advisors. Now let's dive deeper into understanding the fee range you mentioned, which can vary significantly. As you've observed, fees typically range from 0.5% to 1.5%, with exceptions going up to 2% we've seen in some cases. Now, my viewpoint, which reflects a balance of kind of industry standards and kind of practicality, that suggests that fees exceeding maybe 1 to 1.25%, they often require a robust justification. Now, this could include a track record of consistently beating market benchmarks by a substantial margin, or providing, maybe specialized services that directly enhance your financial outcome. On the other hand, lower fees around 0.5% may be justified if the advisor primarily allocates your investments into mutual funds or ETFs. In this scenario, the advisor's role primarily involves asset allocation and periodic rebalancing, leveraging the kind of expertise of fund managers responsible for day-to-day investment decisions. However, as your portfolio grows and your kind of retirement nears, transitioning to a strategy focused on individual securities might become more suitable, especially if you're over $250,000 in assets. So here, a fee slightly higher, say 0.75%, could be reasonable if the advisor is actively managing a diversified portfolio of individual stocks and bonds with keen focus on generating income while managing the risk. Beyond fees, it's essential to consider what services and value you receive in return. A higher fee should correspond to personalized financial planning, tax optimization strategies, and ongoing monitoring aligned with your specific financial goals. Conversely, lower fees might suggest a more passive approach or less comprehensive services, which could be sufficient depending on your needs and preferences. So Peter, when evaluating advisors, it's crucial to ask about their investment philosophy, track record, and how they tailor their services to meet your retirement income needs. Transparent discussion about fees and services ensures you make an informed decision that aligns with your long-term financial objectives. In conclusion, while fee considerations are important, the ultimate goal is to find an advisor whose fee structure and services provide clear value and align with your financial goals and risk tolerance. Great question, Peter. Thank you so much. It's an important topic that can significantly impact your financial future and that of many others in a similar situation. If you have a question like Peter did, you can email it to us. You can email it to poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.